This is a great example of a common business transaction. Here's a breakdown of what's happening. The transaction. Your company is buying supplies and equipment on account. This means you're getting these items now and promising to pay for them later. How it affects the accounting equation. The fundamental accounting equation is assets equals liabilities plus equity. This equation must always stay balanced. Here's how this purchase affects each part. Assets. Supplies. Increase by $2,000. You have more supplies. Equipment. Increase by $10,000. You have new equipment. Liabilities. Accounts payable. Increase by $12,000. You owe the supplier money. Equity. No change in this transaction. Why accounts payable increases? Accounts payable is a liability account. It tracks the money your company owes to others. Since you haven't paid for the supplies and equipment yet, your company now owes the supplier $12,000. This transaction demonstrates a crucial concept in accounting. Every transaction has a dual effect. In this case, it increased both your assets, supplies and equipment, and your liabilities, accounts payable. This keeps the accounting equation balanced. This continues the explanation of how transactions impact the accounting equation. Assets equals liabilities plus equity. Let's break down the information provided. Understanding the situation. Assets. You have a total of $212,000 in assets. This includes cash, supplies, and equipment. How acquired? The key here is that these assets were acquired without paying cash. This implies they were purchased on credit or through some form of financing. Credit card example. The example of using a credit card for gas illustrates the concept. You get the gas, asset, but you also create a debt, liability, to the credit card company. Analyzing the impact. Here's how this scenario affects the accounting equation. Assets, $212,000. This is the total value of your cash, supplies, and equipment. Liabilities, $12,000. This represents the amount owed for the assets acquired on credit. Owner's equity, $200,000. This remains unchanged in this specific transaction. Connecting it to the equation. Remember, the accounting equation must always balance. In this case, assets, $212,000, equals liabilities, $12,000, plus owner's equity, $200,000. The equation is balanced because the total assets equal the combined total of liabilities and owner's equity. Key takeaway. This example shows how acquiring assets on credit impacts a company's balance sheet. It increases both assets, what the company owns, and liabilities, what the company owes. It also highlights the importance of understanding how different types of transactions affect the accounting equation.
Finally, if you like the video, please give it a thumbs up and share it with classmates or colleagues. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. It's always nice to hear from you. If you think there's something I can do better, please leave a comment below the video. So, thank you very much for watching. I wish you the best of luck in your work and studies. I look forward to seeing you again next time.